This makes you money. It doesn't cost you money. In this episode, we are going to address the question, how much does a max-funded IUL, Indexed Universal Life Insurance Policy, actually cost? I'm Doug Andrew, and I've been doing this for more than 45 years. In fact, way back in 1974, when I began helping people optimize their financial assets and minimize taxes and empower their true, or what I call authentic wealth, I actually had a Series 1 securities license, and by 1980, I was responsible for over 3,000 clients in 13 Western states. But these clients were never happier than when I got them out of the market with the whipsaws and so forth and put them into max-funded indexed universal life insurance. It came out in 1997, but in 1980, when E.F. Hutton, who is credited with being the brainchild behind universal life, came out with it. It wasn't whole life, it wasn't term, it was universal life. It was universally applicable on both ends of the spectrum. If you wanted death benefit for a lower premium than maybe whole life at that point, you could get universal life for the most death benefit for the least premium. But Hutton said, wait a minute, why don't we do the opposite? Why don't we take the least amount of insurance we can get away with and put in the most premium, and this thing turns into a cash cow. It was brilliant because it accumulates your money tax-free. Later, you're able to access that money for retirement income or any other purpose, totally tax-free. And when you ultimately die, it blossoms in value and transfers tax-free. No other vehicle in the Internal Revenue Code does that. Municipal bonds don't do that. A Roth doesn't do that. And so when people ask, what does it cost? Sometimes they go, that's the wrong question. How much does it make you? In other words, a business owner understands that if you invest $100,000 on an employee, but that employee makes you an extra $500,000, was that a cost or an investment? And so when you max fund a universal life policy, and then in 1997, my preference became indexed universal life, what is known as IUL, what you're trying to do is get the cost down as low as possible, as soon as possible. So generally, within 10 years, the cost of the insurance that the IRS says has to be there under tax citations, TEFRA, DEFRA, and TAMRA, the cost of the insurance is down around 1% or so. It means that if you're earning 11, you're netting 10. If you earn 8, you're netting 7. If you earn, like some years, our clients have earned 16, they've netted 15. Or if they earn 25, they netted 24. So in other words, one of those percentage points paid for the insurance and all the fees, because the IRS said if there's not insurance attached to this under the guidelines of TEFRA, DEFRA, and TAMRA tax citations, then it's not going to be tax-free. But to me, that's not a cost. It's a benefit because I'm netting 10%. I'd have to be earning 15% in a tax-deferred account like an IRA or 401k to be able to net 10% after tax. And after fees, I'm only netting 9. In an IUL, I only have to earn 10 to net 9, and I've done that predictably for 25 years. So let me share with you something most advisors don't even understand. So under TEFRA and DEFRA tax citations, a lot of advisors, even insurance agents, don't understand that when you take the least amount of death benefit to allow the greatest aggregate premiums to be put into the policy, when you do that, you have the choice of having your cash and the money you're earning, the interest you're earning on that cash value, qualify as part of the death benefit. So if I start out at age 60 and I create a max-funded IUL that will accommodate $500,000, I can't put that in all at once without violating TAMRA, but I can put in maybe about $100,000 a year. And so it's going to take a little while for that to build up to be able to have the cost of the insurance be 1% or less. But if I put in $500,000 and at age 60, the minimum death benefit required is $1,250,000, Once I have 500,000 in there, the actual insurance, the risk to the insurance company is only the remaining 750,000. But if my 500,000 in 7 years at 10% or in 10 years at 7%, which is the low and the high of what I've earned for years on mine, that means my 500,000 would double to $1 million. Now the insurance company's only at risk for 250,000. They're only going to charge me for 250,000 of risk. Well, pretty soon, most of my clients who have used IULs, within 10, 12 years, the amount of cash in the policy exceeded the death benefit required under TEFRA and DEFRA. And that allowed the insurance policy now to increase at 5 percentage points above my cash. But now the insurance has gotten cheaper as I've gotten older because the amount of insurance they're charging me for is less, even though the cost per thousand of insurance goes up when you get older. You're paying for way less. I pay 1/20th the amount of money for insurance that I did 30 years ago because I'm earning so much interest on my policies. The cost of the insurance now is only draining out maybe 1/10 of 1%. But on the average, in the first 10, 15, 20 years, it's usually within 1 percentage point of the gross rate of return on the IUL. So what does that mean? That means that if you were looking at the overall cost, when people say, how much does that cost? Normally, I will show people like a ledger, and I'll say, now, let me compare this to a tax-deferred IRA 401k in the market, in a mutual fund, or to an annuity, or to this vehicle, or municipal bond, whatever. So I could compare to all these vehicles. And I would say, now let me cover up what this one is over here, and which one would you choose? And they would see that the accumulation was usually quite a bit better at age 60 or 65 when they hope to retire in the IUL. They didn't know it was an IUL, but then when I would show them income coming out tax-free, that you only had to pull out $100,000 to net $100,000. In a tax-deferred IRA or 401k, you had to pull out $150,000, pay tax of a third to net $100,000, and they would see the IRA or 401k totally run out of money in 11 years, maybe at age 76. And the IUL lasted to 120, pulling out $100,000 a year tax-free. And they would add that up. And if you lived an extra 20 years, it was an extra $1 million of income or $2 million of income. And then I would say, well, this is what it is. And I'd uncover it and I said, it has a death benefit. This is an insurance contract. Oh, I don't need insurance. I go, well, what does that have to do with it? Make me the beneficiary then. Well, what does that cost? I'm going, what do you mean, what does it cost? Look at what it did. That didn't cost you anything. It made you money. It didn't cost you money. I mean, if I were to go to my employees and say, hey, we have some additional benefits this year for all of you. We have free life insurance. How much would you like? Now, predictably, they go, as much as I can get? Yeah. See, we don't object to insurance benefits. We object to paying for them. So the way I look at it, if I earn 11 and net 10, or if I earn 8 and net 7, that 1 percentage point is not a cost. That is money that would have gone out the window in unnecessary income tax if I had an IRA or 401k. I'd have to be earning 12 to net 8 in a 33% bracket. That's money that would go out the window in taxes, plus another 1% in fees. So why would you have that fee incurred, taxes and fees, when the insurance is actually paying for itself? So it's not a matter of what does it cost, what does it make you? So if you want to see how to make an insurance contract get cheaper as you get older, you must read this book, The Laser Fund. It's 300 pages containing charts, graphs, and explanations. You'll understand this and you'll see how it works in real life with 62 actual client stories on the flip side. And so go to laserfund.com and I'll pay for the book and send it out to you. It's a free gift. You pay $5.95 shipping and handling, and start to empower yourself with answers to questions like this and many others that we post on this YouTube channel.